Greetings, traders from all around the world, as well as all of you cool cats and kittens out there. There's the joke for you, those of you that are apt. Chris here bringing you another presentation brought to you by Earn2Trade. Today we are going to be covering the world of futures versus options. Now this is a fun one for me because this is something that in my private mentoring sessions, a lot of my pupils do seem to show a little bit of confusion between the two of them in the newer category of traders, as well as some of my more advanced traders. I kind of find that they get themselves stuck into one area of trading and really don't know a whole lot about the other. So they might be well informed about what futures are and not so well informed about what options are, or vice versa. So today it's my goal to provide some information to fill in those blanks and maybe answer some of the questions that you have upstairs but we're always too afraid to ask. Now, diving on in, here we go. Let's talk about exactly what these are, and you'll immediately see one of the most defining differences. Now, with an options contract, this gives the investor the right but not the obligation. The right but not the obligation to buy or sell shares at a specific price at any time during the length of the contract. Now, as we move down to futures contracts require the buyer to buy shares and a seller to sell them at a specific date in the future at a specified price with the ability to close the position early. So the key defining factor just right off the bat is actually going to be hidden in the name. With an options contract, we actually have an option. Okay, we have an option to exercise an ability to buy shares of something instead of an obligation to buy shares of something, as with a future where we are signing a contract in order to do such a thing. We are obligated to buy with futures, but we are not obligated to buy with options. Okay. Now, options and futures, they're both financial products that investors can use to make money. Traders use these every day to make money and potentially lose if it goes against them. Both of them can make money, both of them can lose money. Both options and futures allow an investor to buy an investment at a specific price by a specific date. But the markets for these two products are very different in how they work, as well as the risks associated with them. Okay, we're going to dive into options first because first things first, options up here, let's get on into it. So options are based on the value of an underlying security, such as a stock. And as we were discussing in our opening, an options contract gives an investor the opportunity, but not the obligation, to buy or sell the asset at a specific price while the contract is still in effect. Now, that is important to understand, okay? If the contract is no longer in effect, then we no longer have an option to buy something because the contract no longer exists. Investors do not have to buy or sell the asset if they decide not to do so. That is what is one of the beautiful positives that many attribute to options. Now, options are a derivative form of an investment. They may be offers to buy or to sell shares, but don't represent actual ownership of the underlying investments, which is where that derivative nature comes from. Now, they absolutely can materialize into direct ownership of an asset if someone does agree to exercise the option on the contract that they purchased. Now, buyers typically pay a premium. Premium is the word that is used, and you're going to hear that a lot in the options world. They typically agree to pay a premium for options contracts, which reflect 100 shares of the underlying asset. Premiums generally represent the asset strike price, which we all know as the rate to buy or sell it until the contract's expiration date. This date that we're talking about indicates the day by which the contract must be used. Now, there's two different types of options. Let's talk about what they are, and I'll leave it to you guys to take some notes along or just pause the video at any time if I'm going too fast. Now, there are only two kinds of options, and when I say that, I mean there are only two kinds of option contracts. This does not mean only two types of option strategies. There are call options, and there are put options. A call option is an offer to buy a stock at the stock price before the agreement expires. A put option is an offer to sell the stock price at a specific price. Let's look at an example of each of these, and let's scroll on down so we can take some notes here. Taking a look at a hypothetical call scenario first, let's say that we have an investor who opens a call option at $50 for their strike price. We'll say that the stock is currently trading at $49. Now, if this is for a 3-month period, and at some point during that 3-month period, the stock jumps to a price of $60, the investor has a couple options. They can exercise the right to buy the stock, 100 shares for $50, and then they can immediately turn around and sell for the current price of $60, locking in $10 profit per share. Or they can do the more common option, which would be by simply selling the call option and pocketing the profit from the call option to someone else who is interested. Now, if the option is trading below $50 at the time that the contract expires, unfortunately, the option would be worthless. The call buyer would lose the upfront payment for the option, called the premium, as we mentioned before. Now, if we look at a put option scenario, if we have an investor who opens a put option to sell a stock at $100 and the stock's price falls to $80 before the option expires, the investor would then gain $20 per share profit because, remember, a put is to fall. A put is to go down, and when we expect it to rise, we're interested in a call. Now, the option would be worthless if the price, unfortunately, was trading above 100 at the expiry. So once again, just like the call option scenario, just the other way around. Now, if we go into talking about futures and scroll down a bit so we don't focus too much on what's going on up here with options, a futures contract is the obligation to sell or buy an asset at a later date at an agreed upon price. Futures contracts are a true hedge investment and are most understandable when considered in terms of commodities like corn or oil. For instance, a farmer may want to lock in an acceptable price up front in case market prices fall before the crop can be delivered. The buyer also wants to lock in a price up front too if prices soar by the time the crop is delivered. Now, going back to our notepad, we do have an example that I've got written down here for you. And let's say that we have two traders that agree to a futures contract at $50 per bushel on a price of corn. Okay, if the price of corn moves up to $55, the buyer in this scenario will make $5 per barrel, and unfortunately, the seller will lose out on the better deal. Now, the futures market itself has definitely expanded greatly beyond oil and corn, as many of you are well aware. Stock futures can also be purchased, as well as things like an index, like the S&P 500. The buyer of a futures contract is not required to pay the full amount of the contract up front. A percentage of the price is called initial margin, and that is what is going to be paid. An example of this is if an oil futures contract is for 1,000 barrels of oil, an agreement to buy an oil futures contract at $100 represents the equivalent of a $100,000 agreement. The buyer may be required to pay several $1,000s for the contract and may owe more if the bet on the direction of the market itself proves to be wrong. When we talk about who trades futures, well, they were invented for the institutional buyers to begin with. These dealers were intending to actually take possession of crude oil and do take possession of those crude oil barrels to sell to refiners or tons of corn to sell to supermarket distributors, for example. Establishing a price in advance makes the business on both sides of the contract less vulnerable to big price swings. Retail buyers, however, which is what we as traders fall into, buy and sell futures contracts as a bet on the price direction of the underlying security. We want to take profit from the changes in the price of the futures up or down. We generally don't intend to take possession of any crude oil barrels or any bushels of corn. Now, when we go back up here and we talk about some of the differences, if we talk about some options, so with options, they do tend to be more complex, so to speak, than futures, and as such, you can factor that into the risk category. But the good news is both call and put options generally come with the same degree of risk. When an investor buys a stock option, the only financial liability is the cost of the premium at the time the contract is purchased. However, when a seller opens a put option, that seller is exposed to the maximum liability of the stock's underlying price. This means if a put option gives the buyer the right to sell the stock at $50 per share, but the stock then falls to $10, the person who initiated the contract still must agree to purchase the stock for the value of the contract, or $50 per share. The risk to the buyer of the call option is limited to the premium paid up front. This premium rises and falls throughout the life of the contract. It's based on a number of factors, including how far the strike price is from the underlying price, as well as how much time remains on the contract. This premium is paid to the investor who opened the put option, and we also refer to these people as option writers. So the option writer is the person on the other side of the trade. This investor has unlimited risk. So let's assume in the example that we were talking about, the $50 example, let's assume that the stock price went up to $100. The option writer would be forced to buy the shares at $100 per share in order to sell them to the call buyer for $50 a share. Now, they would gain the small premium, but the option writer would be losing $50 per share, which is quite large. Either the option buyer or the option writer can close their position at any time by buying a call option, which brings them back to flat. In order to buy, we must sell, and in order to sell, we must buy, etc., etc. The profit or loss is the difference between the premium received and the cost to buy back the option or to get out of the trade. Now, when we move back over to futures to talk about some of the risk, so even though options have risk, futures are more inherently risky. Futures contracts, at least for individual investors, futures contracts involve maximum liability to both the buyer and the seller. As the underlying stock prices moves, either party to the agreement may have to deposit more money into their trading accounts to fulfill a daily obligation. And this is because gains on futures positions are automatically marked to market daily, meaning the change in the value of the positions up or down is transferred to the futures accounts of the parties at the end of every trading day. Okay, so as we scroll back down here and we revisit our introduction talking about options and futures, the long story short to remember here and some of the key takeaways: options and futures are similar trading products, for that matter, that provide us as traders with a chance to make money and hedge current investments. And that is where they're similar. Now, an option is giving the buyer the right. Remember up here, an option is giving the buyer the right, but not the obligation to buy or sell an asset at a specific price at any time during the life of a contract, but once again, not required. And the big contrast here with futures is a futures contract gives the buyer the obligation to purchase a specific asset and the seller to sell and deliver that asset at a specific future date unless the holder's position is closed prior to the expiration. Both of these are very, very commonly used trading instruments in the trading world. I'm sure most of you are well aware of this, and I do personally engage in both sides of the coin. Both of them have their positives, both of them have their negatives, but it's not on me to instill my biases into them. Instead, I wanted to share with you all the facts behind why each are what they are, what makes each of them what they are, what makes an options contract an option, and what makes a futures contract an obligation. But thank you for joining me, guys, for an options and futures versus each other scenario here. Futures versus options. I look forward to seeing you guys in the next one. Have a good rest of your day, everybody. Cheers, all of you, and happy trading.